Hey guys, Nurse Phil here. Thanks for coming back to my channel. In today's video, I'm going to talk about open enrollment, how you can kind of manipulate the benefits that your employer gives you or that really you've earned to your advantage and how to maximize the wealth out of them. If you're new to my channel, this channel is about how healthcare workers, but really a lot of how the public sector individuals, firemen, police officers, teachers, people of that type of working industry, how they can maximize their wealth and retire early. Guys, I'm going to retire in about 4 or 5 years, and so can you. That's what my channel is all about. So if you like that kind of information, hit subscribe, and I promise you there's some tricks I have up my non-existent sleeves to benefit you. So with that, guys, let's get into today's video, which is about open enrollment, and let's get into it. So what is open enrollment? Well, open enrollment is a time of year where you can decide if you want to pay into certain benefits your employer is offering you. You've earned these benefits. They are basically a form of payment. So let's figure out the best way to take advantage of them. I made a quick little cheat sheet for all the people that don't want to listen to the entire spiel, but for anybody who wants to kind of learn my perspective, how I think about things, and how maybe you can use that information to your situation, then that's what I'm going to talk about now. The first benefit, and definitely the most important benefit, is medical insurance. What is medical insurance? Well, obviously, if you get hit by a car or anything like that, if you need medical care of any sorts, medical insurance is coming in to save the day. So I definitely recommend it. Now, a key thing to kind of make sure of is make sure your doctor is in your network, both now when you file for your insurance, but also in the future if you're getting a new doctor. You'll want to make sure that the new doctor, whether you're giving birth or I know some people that have gone to like one OB/GYN just to learn that they weren't a network and were slapped with a big bill. Whenever getting a new doctor, make sure that the doctor is in your current network, and with your current insurance, make sure your current doctor is in your network. Otherwise, the insurance might not cover the medical bills you'll accrue throughout the year, and it would be an awful shame to pay for something but not get any benefit. Now, the number one reason why people declare bankruptcy in America is due to medical insurance. Guys, this is not something to skip out on. Make sure you have it, your loved ones have it. Make sure either if you don't have it yourself that your spouse's insurance is covering you, or if you're under your parents, make sure that they're covering you. You definitely want medical insurance. Now, as far as what kind of insurance should you get? Well, in my opinion, let's say you have option 1, which has a low monthly payment but a high deductible, and option 2, which has a high monthly payment but a low deductible. Which one should you get? Well, in my opinion, option 1 is better. Low monthly deductible, or excuse me, low monthly premium and high deductible. But why? Well, my mom got cancer a few years back and she's doing okay now, but we were kind of comparing the insurance plans. And in my mom's situation, if she was going to get all these medical bills, it didn't really matter which one she picked. Ultimately, she would be paying something like $20,000 worth of bills, whether that was in the form of low monthly premium and high deductible, or high deductible, low monthly premium. So it didn't really matter. But then I got my mind thinking, well, what happens if she doesn't really use her insurance? Well, then the low monthly premium versus a high monthly premium, that gap, that I guess spread of money, well, if you have the low monthly premium, you get to keep that extra cash, right? And you can pay off credit card debt, you can save it, you can invest it, you can let it grow. So that's why I think it's the better of the two. Now you might say, but Phil, I have credit card debt, I can't afford a high deductible, right? In my opinion, even in that situation, if you have a lot of credit card debt, you probably don't have that much in savings. In which case, if you don't have that much in savings, you're going to be putting the deductible on a credit card anyway. So you're better off taking the cash now, paying off the credit card, bringing that as close to zero as possible, so that way you're not paying a lot of credit card debt. Hopefully, we'll wipe that clean, and then you can start building your savings, and then you'll be able to attack any sort of deductible, okay? So that's kind of my thinking there. The next is a prescription. Typically, that's connected into medical insurance, so just make sure that you have prescription insurance. Dental and vision, this one gets a little bit gray, but if it's under $10 per like mouth or eyes, like if one's 10 and one's 10, if it's under 10, I would say just go ahead and get it. The cost is very small, relatively speaking, and the benefits you can get are decent. And so if it's under 10 bucks per, I would say go ahead and get it. Gets a little gray in that $20 area, right? Let's say you got perfect vision and you've never had a cavity in your life. Well, maybe it's not worth spending that money on. Maybe it's better taking that cash and paying off credit card, or paying or investing it, or using it as a down payment on a house or a condo, right? And at $30 a month, I'm gonna say it's probably not worth it. I would say you're probably better off taking the cash and doing something better with it, right? And if you do face a cavity, paying that out of pocket, right? So then the next topic we'll talk about is HSA and FSAs, right? So what are these? Well, they're health savings accounts or flex spending accounts, but they're similar. They are tax advantage ways that you can put money aside in the event that you have a medical situation come. So let's say you earn $100, okay? And you earn the $100, and then the government says, not so fast. You have to pay taxes, right? So instead of getting $100, you get $80, and the government keeps the other $20. But the government wants you to be prepared in the event you have a medical situation. So they've instead said, you know what? If you put this money into an HSA or an FSA, we'll let you keep that $20 in that account too. So you save money on taxes there. If that money grows because you can save and invest it, then that money will grow, and that'll be tax-free, and it's basically a whole bunch of tax-free money, which is obviously awesome. So why is it a maybe? Well, if you've got credit card debt, in this scenario, I'm going to argue that you're probably better off taking the cash, taking the money, and paying off the credit card debt first. Kind of like what we talked about earlier. You don't know if you are going to need medical care throughout the year. But you do have credit card debt, so you're better off taking the cash and paying off that interest sooner rather than later, right? So that's my kind of tentative game plan, right? Now, there is a major difference between an HSA and an FSA. And the major difference is in an HSA, if you put money into that account, it will be there in the future years, okay? So if you put $1,000 this year, next year, and don't use it, that money will be there in 2022, 2023, 4, 5, etc., right? However, with an FSA, there is if you don't use it, you lose it, right? And this is kind of a trap you got to be aware of, right? Because some people put money into this account, think they'll have access to it later, and then poof, $500 that they could have had just disappears, right? Now, take this part with a grain of salt, I've heard because of the pandemic, there have been rules where they're saying FSAs can roll over and stuff like that. I'll be honest with you, I haven't done much research into that, but it's something to consider. But at the same time, just take it with a grain of salt, do your own research, see if that is the case, but just be cognizant of that. Now you might say, well, an HSA sounds great, I want one. There's a catch with that. You have to have an HSA medical insurance plan. So your medical insurance typically has to have that high deductible and low monthly premium in order to be eligible for an HSA. That's another reason why I like the low monthly payment, high deductible, is because a lot of times it also offers an HSA component that you can put money into, and you can kind of generate some savings that are tax-free and all that other stuff, and they are very good. So that's why I've got the maybes, guys. It's something to consider. If you got credit card debt, wipe that clean. If you're looking to get an FSA, be careful. The money will probably disappear. Check on that yourself. And with an HSA, you might have to have a special type of medical insurance in order to be eligible to open that account. Okay, guys? Moving forward, I've got short-term disability. And full disclosure, I am not a disability insurance expert. This is my understanding of it. I could be wrong. I don't think I'm wrong, but I could be wrong. So make sure to talk with your HR representative, your insurance agent, all that other stuff. I'm just a guy on YouTube, right? So my thoughts on short-term disability are, I don't really like it. The only people that I kind of like it for is if you have lots of debt on a monthly basis, if you have no savings, and if you have a lot of dependents, whether it's kids or adults. How secure is your financial monthly cash flows and stuff like that? If you are in a, for lack of better words, a weak financial situation, short-term disability might not be a bad idea for you, but I want you to kind of recognize that because of to some extent, the financial position that you're in, which is a weaker spot, and I'm not saying that to be condescending, I'm hoping that you take this as kind of like all right, I need to lift some financial weights to get stronger. Because of that, you're gonna have to pay into this insurance that you otherwise wouldn't need. So that's more money that's leaving your kingdom, if you will, going to somebody else, in this case, the insurance company. I'll break down into more depth why I'm not a big fan of short-term disability later on in this video. Next gets us long-term disability. I'm a big fan of long-term. Let's say you get hit by a car and you are now a quadriplegic. Well, you need some money coming in both for you, but also to remove the burden on your loved ones. Guys, that's an important thing with insurance, is you have to think about your loved ones, right? What kind of burden would I be putting on them in the event that crap hits the fan, right? Next, we have life insurance. I'm a big fan of life insurance. Basically, you should add up all of your debts, right? And make sure you have enough life insurance to cover that plus $25,000 of funeral costs. What does that mean? Let's say you've got $50,000 of credit card, student loan, auto loan payments. You'll need $50,000 on top of $25,000, and the $25,000 is funeral costs, right? So in this example, you would have $75,000 of life insurance is what you should have minimum. Why? Same thing. You don't want to put the burden of your passing onto your loved ones. And so another general rule of thumb is you want about $500,000 of life insurance per dependent you have. And it gets a little gray here as well, because obviously a newborn, 1-year-old, or 1 month old is going to require a lot more help than your 99-year-old grandma who's living with you. So there is a general rule of thumb. If you are on a newborn, maybe you should go like $750,000 to $1 million worth of insurance. And if you've got a 99-year-old grandma, maybe, I don't know, $200,000. It gets a little gray, but generally about $500,000 per dependent you have. Similarly, if you're a single parent, you might want to go a little bit heavier on the insurance, where if you have a very fortunate financial situation with your family and spouse and all that other stuff, maybe you could go a little less. In my opinion, it's kind of better to err on the more aggressive side than on the less aggressive side. I'm also a big fan of term life insurance. I'm not really a big fan of whole life insurance. Basically, if you've got whole versus term, whole's a lot more expensive. They say they'll invest for you and stuff like that. Personally, I rather buy the term, take the difference, take that extra cash and invest it. The returns tend to be much higher. My personal opinion, we'll talk about that in another video. Then we have 401k and 403b and 457, that should be a B. Those are all retirement accounts, more or less. I'm going to group them all the same. What are they? Same thing as kind of like the HSA. The government wants to incentivize you to save for your retirement. So they say, hey, you can put money into these accounts and we're going to give you tax breaks galore so that way you can take care of yourself when you're older. Now, if you are on the younger side of the scale and you're aggressive and you're really trying to build your wealth, in my opinion, there's some things to consider. First thing is, are they giving you an employer match? If they are giving you, let's say if you put in 6%, your employer will put in 3%. So if you make $10,000 and you put $600 in, your employer will automatically put $300 in. That is amazing. That is a 50% return, 600 to 300. That is amazing. Do not pass up that free money. Even if you have credit card debt, in my opinion, it's better to take that free money and then tackle that at another time. 50% immediate return versus 20% over the course of the years and while we're simultaneously attacking credit card debt, in my opinion, take every penny of free money you can from your employer in this type of situation. But after that, after you've maxed out the amount of money that your employer will give you, should you invest or should you put money in these types of retirement accounts? In my opinion, no. I'll talk about in another video what I think you should do, but get the max, and then that's basically it. Now, if you're the type of person who already has, a huge financial stronghold that is, owned your house, you're like 55, you're close to retirement, then yeah, they're great. So that's why this maybe comes up. The maybe is if they give you an employer match, right? Then certainly take care of or collect all that employer match. And if you're 403B, 457B, it's a no for the majority of the audience that I'm trying to speak to, and then only if you get close to retirement. Now, if they offer you a Roth option, the general rule of thumb that I think in my head is a decent one is if you are 35 years or younger, get the Roth. If you are 35 to 45 years old, it gets a little bit gray. If you're on the 35 side of that scale, maybe go a little bit heavier on the Roth, where if you're on the 45% of the scale, maybe go a little bit more on the traditional. But in that range, maybe do like half and half Roth, half traditional. And then if you are 45 and older, I would say the vast majority of the time, it makes more sense to go the traditional route. That's my opinion. It's up for debate. But generally speaking, 35 and younger, Roth, 35 to 45, half and half, 45 and older, get the traditional. Okay, guys? So let me go down a little bit more as far as why I'm not a short-term disability fan and why you need long-term disability. All right, so let's scoot down here. So let's say you've been in a car accident, right, on day 0. And then from day 0 to day 30, you have to use your sick time and vacation hours to kind of recoup any lost income you had during that time period, right? Then from day 31 to day 90, this is where short-term disability kicks in. And then from day 91 on, this is long-term disability, okay? So as you can see, long-term covers you for a very, very long period of time, so it's important to make sure that you got coverage there. But as you can see, there's about 60 days where short-term is in play, it's in effect, right? But here's another catch that people don't necessarily know. You only get 60% of your base pay during that 60-day window. So no weekend pay, no shift diff, no nothing, no bonus, certification, nothing, right? So you only get 60% for that 60 days, right? So let's say that's like, I don't know, $3,000, right? And so I've done the math, and in my personal situation, it was going to take me something like 20 years. If I'm paying like $10 a paycheck or whatever it was, whatever money I'm collecting, it would take me about 20 years to basically save all of the money that I would be paid out in the event that I use, or if I'm disabled between day 31 and 90, right? Now, I'm not a tax expert, and I'm not an insurance expert or a disability, I'm not an expert in any of this, right? So take it with a grain of salt. This is my understanding. This is how I've operated, but I'm just kind of giving you ideas. How many times in your entire life have you been disabled past 90 days? Because keep in mind, if you are disabled for 45 days, you're only getting 14 or 15 days worth of benefits. So you're not even getting the full amount, right? In my life, granted I'm a younger, healthier guy, I've never been in a situation where I've been unable to work even for something greater than like 2 or 3 weeks, let alone 3 months. Now, if you are on the older side, or if you go through a lot medically and stuff like that, and there's some issues kind of medically going on with you, then maybe short-term disability makes a little bit more sense. Or if you have a lot of people depending on your income and you don't have a lot of financial savings and stuff like that, maybe it makes a little more sense. If you have a lot of debt going out on a monthly basis and not a lot of reserves, it might make a little sense. But generally speaking, I think what makes more sense is if you were to take that cash and instead of paying it to the insurance company every couple weeks in the event you might get sick or disabled for a long period of time, which is probably unlikely, I would rather take that cash, pay off credit card debt. That's an immediate 20% return if you have credit card debt. I'd rather take that cash and invest it in the stock market or use it as a down payment on your house and all that other stuff. Generally speaking, I'm not a big fan of it, but I guess to be slightly hypocritical because I just said pay off credit card debt, there are certain circumstances where you might be better off getting the short-term disability insurance. But generally speaking, that comes from if you are in a weaker financial position. I'm not trying to throw shade on the people out there. We all have to start somewhere. We all have to lift weights. You're right. So you're lifting a small, let's say you're kind of like financially weak, right? Well, you're going to have to start lifting weights to get financially strong. So there's no shame in that, but you got to kind of pay the costs to move forward a little bit. So just recognize that if you're financially stronger, you probably wouldn't have to, or probably wouldn't need to pay into that insurance. Okay, guys? Keep this in mind. I am not a licensed financial advisor. I am not licensed to give financial advice. This is for entertainment purposes only. Check with your own HR rep, insurance rep, all those types of people. They are the experts. This is how I've run my life. I've done my own homework, and this is how I do things. So keep that with a grain of salt, I guess. So if you guys found this information valuable, please hit subscribe. Please like. Please hit subscribe. It would really help me out. Share it with your friends, coworkers, and family and such. I know this video was long and boring. Thanks for sticking it till the end. Hopefully you found some value out of it. Next video is about how to get Invisalign for super, super cheap. Quick side note, I guess this is a bonus if you watch the entire video. Dental insurance, you gotta be careful. Sometimes they do not include orthodontics for adults. They'll include orthodontics for people under the age of 18, but not necessarily adults. If you work at my institution, there's a new insurance that will offer you like $2,000 towards your benefit towards orthodontics, which includes Invisalign. I'm making a video, it's coming out soon, about how to get Invisalign for 70 to 90% off, so look out for that. And then I've got videos on traveling around the world, how to do that for super cheap, and plenty more content to come. I got so many ideas, guys, up my non-existent sleeves, but I hope you guys check it out. Hope you guys love it, love the show. If there's something you want me to talk about, let me know. Otherwise, I'll see you guys in the next one. Thanks for coming.